Well, welcome everybody to the 4-Star podcast, where we get a chance to interview some really interesting people in the financial advisory world. And we have Dan Moisand with us today. And Dan is down in, you told me some interesting things. You're down in the Space Coast in Florida, Dan. Is that right?
That's correct. We launch rockets around here.
All right. Oh. And I thought the funniest thing you told me earlier was that the area code down there is 321.
That's correct. That's correct. We're supposed to hopefully have a launch today, as a matter of fact. So
that's wonderful. That's wonderful. Well, great. Well, it's a pleasure to meet you, Dan, and talk with you about what's going on in the industry and about your practice, to share all the greatness that you've created in your career and the good you do for clients. So I think maybe we could start out with a little bit about your background and how you got started in the industry leading up to where you are now. And you started with IDS. Anybody remember that name?
All right. IDS, that's correct. They eventually became American Express Financial Advisors. I had moved to rural eastern North Carolina, Greenville, home of East Carolina University, chasing after my girlfriend at the time. That worked out well. We've been married for a little over 30 years now. She was actually my high school sweetheart, so we went back even farther than that. Sold insurance, hated it, but came across financial planning, and IDS was really the only game in town for getting into financial planning. Moved back to this area of Florida, where we're from. I can actually see my high school and the beach from here as well. And that evolved over time. I got a little frustrated with the restrictions that were placed on the scope of the advice that we could give. So I broke off from that outfit back in 97, very late 97, set up a state registered RIA to facilitate financial planning, and affiliated with the independent broker dealer LPL.
Nice.
Yep. So I did that for a few years. When I was with American Express, they just started doing team practices. So I'd gone through an extensive program of planning and to put together partnerships. And I'd had was on a partnership team there for a little while. And that gave me just enough taste of how that could work for me to know that I didn't really want to be a solo practitioner. Just didn't suit me well. I wanted other people around me, and I wanted those people to not just be employees, but to have some skin in the game. It was just my preference, right? I could certainly have hired up, but I ended up searching for partners for a couple of years. And at that point, left LPL back in 2000, went strictly RIA, state registered for a bit. And then merged in with my current partners, Charlie Fitzgerald and Ron Tamayo back. We started, dating, so to speak, back in 2000 and formally got hitched in 2003. We had probably 85 to 90 million in assets under management and one assistant. And over the years, strictly bringing on new clients organically, no mergers or acquisitions involved. We're about 18 employees total, 3 offices, Tampa, Orlando, and here in Melbourne, and roughly 750-ish families, about 900 million in total assets. Yep. So strictly SEC RIAs. We have 7, I think, maybe 8 CFPs. We've got 6 enrolled agents and a CPA on staff. Some of those same person's a CFP and an EA, but so it's a lot different than it was 20 years ago.
Sure. But the idea at the beginning, though, and having been in the industry back in the 90s, I do remember that financial planning wasn't really a big thing, was it, back then?
Certainly not within the industry. It was the case then, and it is the case now, that people desperately need competent and ethical financial planners to help them with their personal finances. There's a period of time in your life where things are relatively simple, but they get complex, and they get complex fast. And over my career, a little over 30 years, and I'm sure yours as well, you've seen it has not gotten simpler. It just gets more and more complex all the time. They don't teach this stuff in schools. There's, the financial literacy is in the toilet. You learn it from your parents who never learned it from anybody but their parents who didn't know it. It's just kind of has perpetuated itself. And then you've got this entire machine, not just Wall Street, but banking and insurance, just pummeling people all the time with ideas about how their product's the best or their ideas are the best. And people don't know how to organize that information and apply it to their situation at all. So that has changed though within the industry, because the industry has realized that people are figuring out that some aspects of managing your finances can be a little bit commoditized. It kind of, I think there is differences in how money is managed, and some groups are better at doing that than others. Not everybody can be great, or above average at it, of course, by the very nature of that. I think there is still a little bit of value in investment management, especially when the portfolios get larger and you can do more interesting things. But there is no shortage of places to go if you just want your money handled for you or your investments managed for you. There's thousands upon thousands of representatives, bank, brokerage, insurances, combined organizations, and all that. And so for the public, it all looks the same. So the public's looking, I think, now more and more, they're realizing the complexity and they're looking for differences between organizations, and they're looking for financial planning more and more. So the big institutions are morphing into at least more holistic advice, if not actual financial planning.
Yeah. So back when you started, it was a financial planning shop at IDS that was part of American Express, right? And that's now, that's what has become Ameriprise.
Yes, I was never with Ameriprise. I left when before that happened. So I left in '97. A long time ago. But yes, that is the current. What eventually became and evolved into Ameriprise. That's right.
And I don't think they have the same financial planning intensity that IDS did back in the day.
Yeah, it seems to vary a little bit more from what I can tell, but there's definitely there's good planners at every organization, just about every organization in the country that I could think of. I could think of several pretty good financial planners. And then there's, it's the bigger the organization, the more likely you are to have some folks that are not so sharp. Or kind to their clients, Yeah.
So that's right. So now, you and you have the two other partners on the door, but you said to me you have 5 partners now, right?
Yep, that's correct. Got Derek Chandler and Mike Salmon became equal partners just this summer.
Okay, great.
Mm-hmm. So they both started with us almost straight out of college.
Nice.
Yep.
Nice. So 5 partners, and then you said you have 6 to 7 people who you would consider to be planners. So are all 5 of you planners, or are you talking about the other professionals?
There are 7 total that are on the ADV.
Okay.
As investment advisor representatives. But we very rarely work with clients just to handle their investment portfolios. Mm-hmm. We want to do the financial planning and incorporate the investment management into that process.
Well, let's talk about that for a second, Dan. So when you talk planning, a lot of people think, oh yeah, just plug in your portfolio and we'll reallocate it or something. What does it really mean in your world?
Yeah, that's we call that superficial planning. And a lot of the financial services business, they are moving more holistic, but that's the extent of what you end up getting. You end up getting some projections for retirement or whether come up with a pie chart allocation, and then we'll handle the assets from there. And it's very focused on that. Real financial planning is much broader and incorporates insurance needs. We don't sell insurance, but we analyze it all the time. Estate planning, taxes, and we do tax planning. That's a point of differentiation for us. With I think we've got 6 enrolled agents and a CPA on staff, and we integrate tax planning and tax advice. And that's something clients can see. When we point out that the wirehouse broker statement says we don't give tax advice to your tax advisor, what does that mean? We don't give tax advice to your tax advisor. It's their corporation's way of limiting their liability. I don't fault them for that at all, but we're not encumbered by that. We could give advice. EAs are licensed by the IRS itself to represent taxpayers. So when we give a piece of tax advice, we stand behind it and we integrate that into the planning and the investment management. And that seems to resonate quite well in the marketplace as well.
So what kinds of subjects do you get into? We've talked a little bit about that. Besides the investments, the obvious thing, what are some of the areas that you guys will weigh in on besides taxes and investments?
Yeah, I think probably the number one thing people come to us, depending on their age, as they're prior to retirement, actual retirement, where they stop working and getting a paycheck, not having a job on the side. It's about that preparation. And, that could get really complex too, right? It seems like you just amass a bunch of money and then you retire early and everything's great. Well, it's not quite that simple because, you got to get money out of these retirement accounts on a tax favored basis. A lot of times now, it's bizarre, but this is the way it works. We don't make the rules. We just try to help clients navigate them. Things like the ACA, the health insurance, right? Prior to Medicare, they can get health insurance. They can actually get a subsidy to pay for it if their income is low enough. So you end up with folks that have all this money, and if their portfolio is tax efficiently managed, they don't show much income, and they can actually qualify for ACA subsidies. It's nuts. We got a client, $2 million plus bucks is very common. And they can get a subsidy if they play their cards right. It's like, why? What is going on here? But that's the way it is. That's the way the rules are now. That wasn't there before. It showed up. So getting people through all these different issues and how they intermingle with each other and interact with each other is really the essence of financial planning. It's strategic. It's problem solving. It's weighing trade-offs and competing interests within a household. You can't spend a buck on somebody's education and your tax bill. It's got to go to one or the other, right? And then as they get into actually retiring, it becomes a function of recreating the paycheck in a way that makes sense for them, given what they've got going on.
For spending.
I think it was Samuelson. I'm not 100% sure of that, but one of the Nobel laureates called that puzzle the most complex puzzle he's ever tried to work on, which is saying something, because there's just so many variables. You don't know what your investments are going to do. You don't know how long you're going to live. You don't know what inflation's going to be like. You don't know how the tax code is going to change. It just goes on and on and on, all these things. So you can come up with an analysis and a plan, and like that, needs to be looked at again. And that's just on the financial side. I mean, we're human. We have families. Our kids don't always marry people we like. We're not always healthy.
Right.
We don't always like our job and want to switch to a lower paying one, or we have an opportunity to switch to something that could be life altering in a good way. All these things, all these decisions have to be weighed against what's important to the client. So that's the essence of planning. It's a very broad subject matter.
So the estate planning part of it, I think you ventured into that discussion a little bit there. How does that play into your service when you work with a family?
Yeah, and obviously we're not lawyers, and it's illegal to give unauthorized to perform the unauthorized practice of law in Florida. So what our role is, there's a couple things. One is just to kind of organize the client's head around the whole subject of estate planning. And, they know that they should probably put this stuff down in writing, but they don't really think through all of it. So forget the estate taxes, right? I mean, we got a $12 million exemption now. It's not as big an issue, but estate planning is as much for the living as it is for the heirs after somebody passes. My own father had dementia, Alzheimer's, passed away in 2018, and we got to see all of these basic estate planning documents work in real time, in real life. Wow. So I'm the one that went with mom to the bank, present the power of attorney, and have to go through 15 tellers, but we did, right? The branch managers and all that stuff. We did, and the power of attorney worked, and mom was able to do what she needed to do with those accounts that applied to. Dad had a trust in place, and she was able to take over as successor trustee. That went pretty smooth. He also kind of faded away the last few days. And when my sister came up from Miami, she was a little rattled by the whole thing. I mean, of course, we know Dad's going, but he had very explicitly asked not to be kept alive with feeding tubes and the like. And for her, it was a matter of us doing something to Dad, right? This is terrible. And we showed her his living will and his healthcare power documents. And they were very explicit. If I am in this condition, the exact condition he was in, I don't want these things to happen. And literally within the matter of minutes, she went from we're doing something to him to we're doing something for him that he wanted to have happen in that situation. So I've seen all of this work. And my parents are not in the estate tax bracket by any stretch. I've seen all this work, and it's really about control and decision making. And so we walk them through that process. And then when they need trust, we walk them through the process of basically how they work without getting into too much detail. Thoughts about the trustees. You don't have to name, for instance, the caretaker of your children to be the caretaker of your children's money. This could be two different people.
Right.
So just through this whole thing, just what's possible. And then they're better prepared to go see the attorney and get the documents drafted. And they feel better. The attorneys love it because they have a really prepared, thoughtful client in front of them. And it works much more efficiently. And our second role is just to nag the hell out of them like a loving parent to get the damn things done because, that's just the way it is. I mean, I procrastinated mine too. My dad, who I mentioned had dementia and died a few years ago, was actually a trustee after me in my documents for years. It's like, oh man, we got to change that, right? It's so easy to put that stuff to the side.
Not here. Yeah. Well, that's great. You saw it play out in your own family, and then see how that works in other families as well. And being a professional financial planner, you get to kind of be on the outside and all those emotional discussions about what are you doing to Dad and what's going on with Dad and all that, and all those things that are in everyone else's head, which is really a key function of a professional financial planner, is to have a step back, right?
Yeah. And I never say I know what you're going through. I say I think I could relate a little bit to it because of my own experience. Empathy is so important in having a good, trusting relationship with a client.
Absolutely. Well, great. Now, we did talk earlier about some distinctions in our industry that you thought were important. The term financial advisor as compared to financial planner, then the term of wealth manager. Why don't we talk about that a little bit? Because I think that kind of really highlights how you guys operate and what those distinctions mean and how you fit in. So tell us, it was like financial advisor versus financial planner.
Yeah, you probably experience this too. Occasionally you'll be at a social setting and somebody will say, oh, my brother-in-law is a financial advisor or something along those lines, right? And I've been in business now for 30 years. I've been licensed as an insurance agent, a broker. I've been state registered RIA. I'm SEC registered RIA now, certified financial planner, all that kind of stuff. I have no idea what the man does for a living when I'm told he's a financial advisor. It has almost no meaning whatsoever. Reg BI added one little twist. They finally did this just recently, that if you are not registered in any way as an advisor, you can't call yourself an advisor.
Okay.
They finally got around to doing that.
Good enough. Yeah.
Now, I know the questions to ask, and I know what to do with the answers, so I can kind of figure out what the person does. I can figure out whether they're just an insurance agent, if they're in a hybrid situation, or an RIA, or any mix out there, right? I could figure that out, but the public can't, because it just doesn't have any meaning. Financial planner as a term is a little bit better, because in a lot of states, if you use the term financial planner, you need to at least be registered with an investment advisory firm, which brings in the possibility of a fiduciary standard of care. But that's not true everywhere. It's not particularly well enforced. Financial planner to me is a term that should and does suggest a broader scope of services, and all-encompassing, a comprehensive, coordinated approach to personal finance. Certified financial planner designation certainly has helped make that clear, as more and more people are getting that designation and tuning into what planning is and isn't. Wealth management, that's for the most part, financial planning for people with money. It hasn't manifested itself that way fully within the financial services industry. It's very similar to what we talked. When I see it in very large institutions, it looks like what we would call superficial financial planning, where there's some level of analysis that's really designed to construct a portfolio allocation and then have somebody manage the money for them. They stay out of the tax planning. They don't, they make general suggestions about this other stuff, and they don't get into making it all work for clients. But I would, the public's up a creek, man, because the regulations are just horrendous. They're not making anything clear to anybody. And a lot of improvement could be made there by the regulators. And I don't think the problems with the folks that meet with clients on a day-to-day basis by any means. I mean, I've been all over the world over the years and talked to thousands upon thousands of financial planners for various things I've been involved in over the years. And the vast majority of people that are in this business, sitting across from normal American families, trying to help them with their finances, are genuinely trying to do a very good and ethical job of it. It's the systems, the conflicts that are embedded in the systems that can rear their ugly head. And if you get a bad person in a flawed system, you end up with bad results. But for what I see, there's a lot of bad, flawed system out there. There's a lot of good people in the flawed systems.
So we could consider some ideas of reform, and that might hopefully give people a little more clarity in how our industry works. Perhaps that's not.
Yeah, but it doesn't seem to be working that way. I mean, the SEC put out Reg BI, Regulation Best Interest, and they explicitly did it and stated it's not a fiduciary standard. And then they called it Regulation Best Interest, which to any lay person, if you ask them what a fiduciary is, the most likely answer they're going to give you is somebody that has to act in somebody else's best interest. So it's just muddled. Form CRS is not a bad idea, but the execution of it, the mandatory language in there is just horrendous. So there's a lot of room for improvement with regulation. So
yeah. Well, and then you've also informed me that in addition to being the planner, you guys also run some of the portfolios, right?
Yeah, we manage the assets for the clients. It's not particularly tough for us to do that in-house because we use, mutual funds and ETFs, and it's pretty plain vanilla. We seriously joke, right, that we want to make it as boring as possible. There's a place for trying to outdo the market and be crafty and all that kind of thing. But when it comes to your long-term life goals, the approach of plain vanilla, boring, has a very good track record for anybody with reasonable goals and expectations. So that's who we're trying to work with. And people self-select. If they want more excitement from their investments, we're probably not the right firm for them. And you want boring, we're there for you.
But boring is good, though, isn't it? Why is boring good?
The whole Wall Street machine is to make it more exciting than it should be or needs to be. I mean, they still make money by getting people to move their money around. They're not making like they were when I first started, on the commissions, but there's other ways, and it's all based on most of it's based on moving money around. So, but that's the institutions. You get down to the individual representative level, and you've got a lot of very intelligent, level-headed, competent people just trying to do what they can within those conflicted systems.
Yeah. So by having a portfolio that meets their goals, then maybe they don't need all the excitement. They might want it. They could go to Las Vegas. They could do different things, but really, the long-term execution of a plan sounds like you've got that pretty well in order.
We think so. I mean, we've managed. I've survived 250% plus downturns in the S&P during my career, the tech wreck and the Great Recession, and they were very different, yet they were exactly the same as every other major decline. They ended and we went to new highs. And there's reasons that happens, and clients don't understand that. All they hear is, it's bad, it's bad, it's bad, it's going to get worse. We're down 50%. That means we have to double to get back to where we were. It'll never happen in my lifetime. Well, it not only has always happened, but far shorter period than your lifetime. It's just something that comes to people that are disciplined about it and diversified. I mean, if you got all your money in one company, it might not come back in your lifetime, right? But if you've got a good plan, and a plan that doesn't dread market declines, it expects them, and you know what you will do or should do when that happens, it's still not easy to do it. But your odds of actually making the changes that should be made, right? You should be buying when the market's down. You have a much better chance of doing that if you know it's coming, and you know that it's worked, and you know why it's worked. So that's part of the coaching element. And man, the Great Recession was very, very different than the tech wreck and COVID, because nobody understood what the hell was going on. With COVID, it was easy to get people to imagine a period of time where either the disease was gone or we had learned to live with it. They didn't know how long it would take, but they could envision that being the case. Right. Great Recession, no, man. Mark-to-market accounting. I remember that story I tell all the time. Was a client of mine calling, "Hey, what do you think of the TED spread?" I'm like, "Bill, do you even know what a TED spread is?" "No, but the guy on TV says it's critical." It's like, stop watching the damn TV, But it was very hard to explain why we thought we would eventually come out of that, and it would come in plenty of time. So yeah, I mean, all bear markets are bad. They're all the same, and they're all different.
Yeah, but they also create opportunities, don't they? That's what you're saying.
Yeah, absolutely.
So, do you do anything particularly to be prepared? Should you go through one? Do you raise cash and you're ready, or do you stay with the portfolio that you have and then look to deploy new assets when the markets are at low levels?
Yeah, no, we rebalance. So the vast majority, very, very few clients have 100% equity allocation.
Right.
Clients, we're particularly good with clients that are getting really close to retirement and after they've retired, post actual retirees. Mm-hmm. And we've got some skills in some other niche areas. So it's very rare that any of them should be, need to be, want to be 100% equity. So there's always some dry powder there from the fixed income side of the portfolio. And rebalancing, it works really well. And it doesn't matter if you're early or late, the math works out as long as the market eventually recovers. And so that's how we approach it. It's just a matter of exercising a rebalancing discipline.
Do you rebalance based on market conditions or based on time, or how?
Yep, we're very evidence-based here at our firm, to the extent that there's evidence to consume. And there's been a fair amount of research about that, and it's pretty clear that the most effective method is to do it based on market conditions rather than a calendar. And especially in taxable accounts, you're cutting down the number of transactions that could generate tax issues by doing that as well. But so there's tolerance bands around equity versus fixed. There's tolerance bands around the different equity classes. The technology these days really helps identify when those thresholds are broken, and then it's up to us as the advisors, the planners, to determine how to go about and execute a needed rebalance.
Nice.
Yep.
So you have market triggers or valuation measures and other things rather than just, hey, it's the end of the quarter.
Correct. Now, I think it's better for most people to I'd rather have rebalance on a calendar basis, quarterly, annually, semi-annually, every 2 years, whatever, than never rebalance at all.
All right.
You're never taking any chips off the table when you've been rewarded for taking the risk. You're never buying things at a sale price when the risk shows up if you don't rebalance. So I think that's better. But the studies show, and our experience has borne out pretty well, that the tolerance-based approach is a little bit better. I think it's so I was speaking on this exact subject, rebalancing, at the NAPFA conference in Boston in the fall, and you may or may not get a return bump through rebalancing.
Okay.
You very often do. It's typically 50 basis points or so over a stretch of many years. You will get the benefit of keeping the portfolio in line with the risk exposures you designed in the portfolio, right? So if you think this client is 70% equity, 30% fixed, and X% of the equity is in this class and that's the risk profile you think is appropriate for this client, the real guaranteed benefit of rebalancing, regardless of what discipline you use to do it, is that you stick to that risk profile.
Right.
Right. That's the guaranteed result. The sometimes result is returns, and the other sometimes result is psychologically. When things go bad, people want to do something. They really do. They want to do the wrong thing most of the time, right? But they want to do something, and they also want the portfolio to recover as fast as possible. Right. Well, when you buy when things are low, you get more shares at the low price. So the shares don't have to increase as much to get you back to whole. Mm-hmm. And that math works whether you're early, late, or right at the bottom. Doesn't make any difference. The timing is not right. You will get back to whole quicker if you buy in a rebalance when markets are down, as long as your fixed income remains somewhat stable. So you don't want to be overweighted in long-term bonds or junk or something that could go in the toilet. But if it's relatively stable, that's how the math works. So, and they see that you can explain that to them. They go, okay, I do want to do something. I don't want to just sit here. Now I know, you've been telling me this is what we're going to do. Now you're reinforcing this is what we're going to do, and you're reminding me why we're going to do it. The vast majority of clients go, okay, let's stick to the discipline and do what we said we were going to do. And they make a little sign of the cross or whatever, depending on their beliefs, and hang on for dear life at that point. But
well, that's great though. Really sounds like you have a handle on how to manage the money, and then how to manage the client, and then manage their emotions. And sometimes it's better for other people to look at the situation, and we're too emotional about our own portfolio and our own family and everything else. And it sounds like you provide a great service in that area.
Yeah, it's about preparation. A story I tell them all the time is years ago, I got to go to the Daytona 500 up the road here for the first time. And it's quite an experience, man. It is spectacular people watching. I mean, you can bring your own beer in there. It's all good. And a lot of people bring a lot of their own beer. But you also could get headsets and listen to the drivers talking to each other and to their teams. And so the crowd's going nuts. These cars are going 200 miles an hour. They're literally bumper to bumper going around this track. And you listen to the drivers and they sound like they're driving to church on a Sunday. There's no about if they win or something bad happens, they get amped up, right? But between that, they are as calm, cool, and collected. It reminds me of the astronauts and all the people at the space center. When you hear the launch, you're all, is this going to work? Is this going to blow up? Oh my gosh, right? But they're all very low key. And the reason for that is preparation. And you think about it, if you're driving 200 miles an hour, you're getting on a tube full of fuel, you don't want to have any doubts about what to do and when to do it, right? So it's all about rehearsal and preparation and knowing that these conditions can change and what to do in certain circumstances. And you can't be quite as monotonic as some of these folks that you hear on these headsets, but you could be prepared. And it's just asinine to me to have an investment portfolio and think that the market's not going to misbehave quite frequently over your lifetime, because it's never done anything but misbehave a lot. So, and again, not dread, expect declines and know what to do when that happens.
And have a plan. And that's why we, Well, it sounds like you really do have a plan, Dan. And I think we need to leave it there. Maybe we can do a follow-up another time. It does sound like you guys have a great program. You got some really interesting experience that led you to where you are now. And now you've got a great program with, $900 million under management and a lot of really good clients, and you're a credit to the industry. So thank you for sharing a little bit of this with our guests, our folks here in the 4-Star podcast. And thanks so much for being with us today, Dan.
Well, I appreciate the invitation. Glad you're doing this. There's a lot of folks out there that are doing the right thing. And I think when they listen to a show like yours, they can get a little bit of positive reinforcement from other good guys out there. There's more good guys in our business than bad guys, despite what the media says. And we need to appreciate that and support each other. So appreciate you doing what you're doing.
Thank you. And we all want to be part of that good guy list for sure.
That's right.
So maybe we ended today with a 3, 2, 1, huh?
Sure, that's right. 2, 1.
Boom. Okay. Thanks everybody for being with us today. Thanks, Dan, for being with us on the 4-Star podcast. Thanks so much.
Thank you.